Okay, today we're going to talk about fossil fuel divestment. And the quasi-final exam questions for today are: where do energy companies get the money to build new infrastructure? Number two, what are institutional investors and why do they invest in energy companies? And number three, what considerations are important to an institutional investor when divesting from fossil fuels? So, like a lot of our lectures, we're starting with the basic premise that climate change is a serious threat that we need to do something about quickly. Limiting the average global surface temperature increase to 2 degrees Celsius over the pre-industrial average is sometimes regarded as an adequate means of avoiding dangerous climate change. I think more recently this target has been adjusted down to 1.5 degrees Celsius, but for today we're just going to assume that limiting temperature increases to 2 degrees Celsius is the target. If we start with that target, what we can translate that to is a carbon budget. So we can translate a global temperature increase of 2 degrees to a certain amount of carbon dioxide that the world can emit before we go above that temperature threshold. And the international scientific community estimates that this budget is about 1 trillion tons of carbon. As of 2011, we've already burned through about 52% of that budget. And of course, we're even further along today in 2019. In most models, global emissions have to peak by 2020 and then decline quickly in order to zero in order to achieve this goal, right? So in this, we've seen this figure several different times. The different colors represent different representative carbon pathways, or RCPs, and each one of those is sort of associated with a different end case in terms of average temperature increases, right? And so we really want to be on this blue trajectory, and in order to hit that blue trajectory and stay within a 2 degree Celsius increase in temperature, we need to peak our emissions, which are tracked on the first y-axis, by about 2020, and then they have to decrease pretty rapidly and actually go negative towards the end of the century. So what that implies is that to have a reasonable chance of keeping warming below 2 degrees Celsius, the cumulative carbon emissions between 2011 and 2050 need to be limited to about 1,100 gigatons of carbon dioxide. Unfortunately for us, the embedded greenhouse gas emissions contained in present estimates of global fossil fuel reserves are about 3 times higher than this amount, which means that if we were to extract and burn all fossil fuel reserves, we would go way beyond the emissions limits that we would need to impose on ourselves to keep temperature increases within 2 degrees Celsius. So I mentioned this term, fossil fuel reserves. We've seen this before, and it's worth being a bit specific about what it means again. So fossil fuel reserves are resources that we know exist that are technically recoverable under current economic conditions and have a high probability of actually being produced. So that doesn't actually mean geologically what fossil fuels exist. That we would refer to as fossil fuel resources. Reserves are fossil fuels that we know exist from a geological standpoint that we also think would be cost effective to extract. And when we were talking about the natural gas industry, one of the interesting things that we saw, I showed you a plot of how natural gas reserves have actually increased dramatically over the last 20 years. And that's not because there's more natural gas under the ground than we thought there was. It means that we now have new techniques for extracting natural gas, namely horizontal hydraulic fracturing, that allow us to cost effectively produce more natural gas than we really thought possible previously. So what this figure shows on the y-axis are embedded CO2 emissions in different types of fossil fuels. The lighter colors represent non-reserve resources. So these would be fossil fuel resources that we know exist, but we don't think are economically feasible to extract at this point. The dark colors represent reserves. So these would be fossil fuel resources that are under the ground that companies like oil and gas companies or coal companies have invested in invested in locating and in building the infrastructure that might be needed to extract those fossil fuels and process them and even transport them to a point of end consumption. And so what we can pretty clearly see here is that if you add up all the dark brown colors, which represent the embedded CO2 emissions in fossil fuel reserves globally, and you sort of stack them on top of each other, they would go well beyond the green bar, which represents the range of CO2 emissions that we would need to stay within in order to keep the global temperature increases below 2 degrees Celsius. So that means that there are a lot of fossil fuel reserves that are unburnable, right? And so there have been a lot of estimates. There have been some estimates that have come out suggesting what proportion of different fossil fuels we would need to keep under the ground in order to stay within this 2 degrees Celsius temperature increase. And so these estimates are a little bit uncertain, but some sort of general agreement is that about 80% of proven coal reserves need to stay in the ground, and about 50% of proven natural gas reserves need to stay in the ground, and about 33% of proven oil reserves need to stay in the ground. And the assumption here is that they need to stay in the ground and not be burned unless we're using some sort of carbon capture and sequestration, which we really haven't talked about at all in this class. It's not cost effective to do that at this point. So we're assuming that if these fossil fuels were extracted, they would be burned and then the CO2 would go into the atmosphere. So we've talked about different approaches for essentially decarbonizing energy sectors and other sectors of the economy as well, right? So cap and trade and a carbon tax would apply to every economic sector. There's certain tools we might use to decarbonize the power sector specifically to reduce reliance on coal. Examples would be renewable energy supports like tax breaks, renewable energy performance or portfolio standards, the utility death spiral, things of that nature. Today, we're going to talk one other option for decarbonizing the energy sector and trying to keep fossil fuel reserves under the ground. So that option is called fossil fuel divestment. And so the word divestment really just means the opposite of investment. Instead of buying stock in fossil fuel companies or buying bonds that are issued by fossil fuel companies, divestment means that there are certain entities that are voluntarily selling these financial holdings and or pledging not to buy more. So we've talked about this a lot, right? The energy business is very capital intensive, which means it needs, energy companies need lots and lots of money to build the infrastructure required to find, extract, refine, transport, and then finally use or burn fossil fuels. And to get that money, companies usually have to borrow it. And so when we say borrowing, we mean a couple different things, right? If you're trying to finance infrastructure, you could use debt or equity. And remember, debt is a contractual obligation to pay money back with interest. It's a lot like a loan. And if you don't pay that money back, general rule of thumb is that you go bankrupt. If you are financing something using equity, you're basically using shareholders' money or the owner's money. So equity is money acquired through issuing stock. So you're sort of borrowing money from shareholders. There's a trade-off between financing things using debt and equity. There's no firm obligation to pay equity back, but usually shareholders expect a higher rate of return because they're taking on greater risk. There's no guarantee that they'll be paid back. So they expect a higher rate of return. So we can zero in on debt financing here. Remember, if you are a utility or a fossil fuel company and you want to raise money to build some piece of infrastructure, you don't really take out a loan. You typically will sell bonds. And so, for example, to fund a power plant with a capital cost, a sticker price of $500 million, a utility might sell 500,000 bonds each with the principal of $1,000. So when people are buying those $1,000 bonds, that money essentially goes to the utility who can use it to build the power plant. And lots of different utilities offer the option of becoming what's called a fixed income investor. That means that you are owning the debt of these utilities, you're buying the bonds. And the fixed income part of it just means that the rate of return is predetermined, right? So the interest rate that you earn on your initial investment of $1,000 is set in advance, and you know what that's going to be, and it's sort of constant throughout the life of the investment. So, for example, if we assume that we were buying a bond, $1,000 bond that had a coupon rate of 4% per year, in year zero, we would buy the bond. So we're essentially lending the utility $1,000. And then in year one, we would earn 4% on our initial investment. So we would get a payment of $40. In year two, we would earn another payment of $40. So 4% on our initial investment, and we would earn $40 for every year 1 through 25, and then also in year 25 we would get our initial investment back as well. And so at the very end we would have $2,000. So we started out with $1,000, and over 25 years we made another $1,000, 4% per year on our initial $1,000 investment. So we would end up with $2,000 at the end of this 25-year period. Equity financing, again, is a little bit different. So this is where companies are using new and or existing shareholder money to pay for projects. Not technically called borrowing because you're not paying interest, but investors do require a return on equity, so profits, and that could come in the form of a stock price increase or dividend payments. So here's a question that we've sort of answered earlier in the semester. Who do you think owns Duke Energy stock? And so the hint here is that it isn't actually any longer anybody with the last name Duke. It's a long list of companies, some of whose names you might sort of be familiar with, and others we've never really heard of. And so you can, all the names of the different owners are on the left, and then the percentage of their ownership of the company is listed in the right. So the largest single owner of Duke Energy is the Vanguard Group, and they own, at least as of 2018, 2019, about 7 or 8% of Duke Energy. So what that should tell you is that there's no single large owner that owns, for example, a majority of the company. Really, the ownership of Duke Energy is split up into lots and lots of little pieces, and those pieces are all owned by these companies that are called institutional investors. And so institutional investors can be any of a wide range of different entities, including insurance companies, pension funds, hedge funds, university endowments like the endowment for NC State or UNC Chapel Hill or Duke, mutual funds, banks, etc. In short, institutional investors are entities with lots and lots and lots of money. And that money is often accrued by collecting it from or on behalf of ordinary people. So you could think about this not necessarily as a pyramid scheme, but as a pyramid, right? So there are lots of people on the bottom who are giving their money to other companies to sort of invest on their behalf. And so what these institutional investors do is they diversify, or they spread out their investments in many, many different types of companies, hoping that on average, even if one company does well and another company does not so well, on average, they'll be able to earn a stable, predictable profit that they can redistribute to the people who are contributing money, whether that's people that are buying insurance or giving their money to a university or investing in a mutual fund. So what this means is that companies like Duke, so publicly traded investor-owned utilities and other types of energy companies, are sliced up and owned by lots and lots of big investors who in turn represent lots and lots of small investors like yours truly. So actually my retirement savings that is taken out of my paycheck from NC State every month is put into an index-based mutual fund that is administered by the Vanguard Group. And I have no idea where the money goes, right? So it goes to the Vanguard Group and they invest it on my behalf, and some piece of it may go to companies like Duke Energy. So the average institutional ownership in the top 50 publicly traded companies was about 64% at the end of 2009, compared to 49% at the end of 1987. So what this means is that the size and importance of institutional investors is growing. And so as a result, their influence in financial markets is growing as well. So when we talk about financial divestment, or fossil fuel divestment rather, what we're talking about is a pledge of these institutional investors who increasingly have sway in financial markets to not buy the stocks or bonds of fossil fuel companies. And so there's a growing list of universities, cities, and foundations that are divesting voluntarily or under pressure for essentially their constituency.